It's to no one's surprise that UPS investors are incredibly unhappy, and now for quite some time. In fact, we're also starting to see many analysts lower their price target. Morgan Stanley, for instance, dropping it to $75. We have Bank of America cutting the company down to a sell. And while some analysts believe that it can keep up with the market overall, we are starting to see some downgrades. Now, the thing that makes this company attractive is that it has a yield near the 8%, but currently the dividend has come under question. We're talking a 50 borderline safe score, with the company for quite some time now really only offering some very trivial dividend increases. So the question is, are we looking at a company that A, is a massive opportunity, very nice upside as well as a high yield, or in fact, is it a value trap, and are we going to see a dividend cut very soon? We're going to get into that and more, as well as the valuation. But if we just look at how the market's been in the last week, many companies are looking fairly strong. We're talking moving in the right direction, but that's not something we're seeing for UPS. They are in fact flat on the week, and that might be a surprise when we're seeing investor sentiment is sitting in greed. Clearly, lots of investors are buying stocks. It just looks like the ones they are buying aren't in fact United Parcel Service, and we can see investors having FOMO, fear of missing out. One company though they don't really care about looks to be UPS, and that's clearly obvious when we see year-to-date performances. Lots of companies up strong double digit. Something we note for UPS, the complete opposite. They are in fact down around 33%. If we look to a competitor, FedEx, whilst they are also down, it is to a much smaller degree. We're talking 18%. So is it a buy? Is it a trap? Let's run through. Last year as well, they're down 36%. In fact, if you invested into this company 10 years ago, you would have had less right now than your initial investment. And it's also one that's trading pretty much at a 52-week low, quite some way away from 52-week high, $145. But if you wanted to see their all-time high, you would have to go as far back. We're talking more than 3 years ago, where it sat at $225. Now, in terms of the ratings, only Wall Street really has a buy, 3.7 out of 5. That is very weak, with both Seeking Alpha and Quant deeming this company to be a hold. And if we look at it on a forward valuation, well, 12.7, it is below the average at 16.2. In fact, the lowest or in line with their 5-year low, and this is what we would typically say a potential undervaluation signal. The only thing we want to highlight is that we don't look at any of this in pure isolation. Also, the yield near the 8%, well above the 5-year average at 3.6, another, as we would say, undervaluation point. But there is that possible dividend cut overhanging. The other thing to make note of is the blue tunnel methodology, which within the parameters highlights the expected price. Yes, we note disparity between the value today and the lower end, so potential, again, undervaluation, but we should make it clear that the intrinsic price has been decreasing in the last 12 months, not something we would say is an attribute of a high quality company. And actually, if we zoom out to the last 5 years, we can note from 2022, this company's intrinsic worth has been decreasing. And whilst more often than not, the company trades within the reasonable signal, we are now seeing a potential undervaluation, which is also in agreement when we look at Seeking Alpha's valuation grade of an A. Ultimately, the sector is trading at a much higher valuation, 21, so you are getting a 38% discount. Against their own 5-year, as we just pointed out, you're getting a 23% discount, so maybe one to consider if we're looking solely at valuation. But as always, this doesn't really paint the full picture of the company and some of the issues that may lie ahead. If we were to do the same comparison but for FedEx on the valuation, where they're trading at a forward P of 12.2, which actually isn't too dissimilar from their average, so we would call this a reasonable signal, but the yield you are getting higher, 2.5 versus their historical 2. And on the blue tunnel, we do notice sitting pretty much around the middle, so another reasonable confirmation. The intrinsic price, unlike what we saw for UPS where it was decreasing, is pretty much, you could argue, flat. And over the last 5 years, you do get a bit of a turbulent ride, something we also noted with UPS. We'll also compare the industry as a whole to understand if these are isolated events or if maybe the industry is just not looking good. And unlike UPS, we do notice clearly the yield significantly lower. We get an above inflation increase this year, whilst dividend safety does look to be safe at a 64 score, and also a fairly attractive valuation grade at a B+, again trading at a discount to both the sector and also marginally their own 5-year. Now getting back to UPS, we can see in their latest earnings something that investors never like is a lack of guidance, which could signal management are very worried about where the future lies, at least in the shorter term. And we also notice weaker results highlighting challenges that are expected. And ultimately, due to the poor economic visibility, they will not be able to give any guidance. At least they're being honest with investors, but that also is driving the share price down, or at least has done over the last few months. And the CEO is saying that right now it does look like an unsettling time for the company. Now they pointed this to some changes in the trade policy that currently haven't been cemented, and this is leading to an impact on customer demand. Ultimately, that is why we are seeing their revenue generated not where management want it to be, and also higher than anticipated expenses. Again, all of these leading to less and less shareholder return over time, something that should be accounted for when you are looking at considering investing in this company. And if we look at the next 4 quarters, well, actually the next 2, they're anticipating a double-digit decrease to the EPS. 3 of the next 4 decreases, a positive anticipated. We're talking all the way into Q2 2026. And whilst they have a 75% track record, 3 out of 4 beats, the most recent quarter they did unfortunately miss, although marginally by 2 cents. Now looking forwards to December 2026, if they can hit this EPS, although currently it is a bit up in the air, the forward P will lower again to around 11.6. Now it wasn't that long ago that we heard the company were going to be cutting around 20,000 jobs. Now on one hand you could argue, yes, that's bullish, lower expenses, higher bottom line, but we also need to understand the reasons why they are cutting these positions. And we can see here they're breaking ways with Amazon.com. It's also their biggest customer. So yes, you could look at it bullish, 20,000 less employees on the payroll, but at the same time, the reason for this is not bullish, it is bearish. They are ultimately losing their largest customer. And we can also see just a few months ago, they're offering to buy out some of their drivers. It's noted here the first in 117-year history. And unfortunately, that isn't a positive record that they have broken. They note here flat parcel volumes, which ultimately drives their top line. The more parcels that they can sell, the higher the volume, the higher their revenue. And alongside that, rising labor costs. Again, these are things that are clearly noted from a struggling company. And if you're a shareholder, probably not great to see this buyout. We're noted here that UPS drivers are among some of the highest paid delivery drivers in the United States, where in fact a full-time average driver will earn around $170,000. That is why ultimately this buyout looks to be very, very costly. And we can see, whilst this is referring to the first quarter, they had a 3.5% decline in the average daily package volume. Lots to consider. Doesn't necessarily mean the company is uninvestable, but we need to see the whole picture before deciding whether this is a buy or perhaps a hold or avoid. And another thing which is bearish, it affects in fact both FedEx as well as UPS, is the end of the de minimis rule, which effectively ends the exemption of packages worth $800 or less entering the US. So one way or another, the company is affected whether they absorb these additional costs or pass it on to the consumer, which in turn may mean consumers are lowering the number of packages that they use or they order. Now, what do the metrics of the company say? We can kick it off by looking at some key metrics of the last recession, the 07-09. In fact, the dividend itself, they didn't increase it, they didn't cut it, they maintained it. They had negative 12% recessionary sales, which was pretty much the average across the S&P, and they marginally outperformed, negative 48, S&P itself, negative 55. Now, dividend growth, historically pretty good, 9.3% on average year on year over the last 10, 11.2 over the last 5. But over the last few years, very, very trivial increases. We're talking below 1%, 0.6. In real terms, that is well below inflation that is historically around the 4% average rate. Now, yes, they have been increasing those dividends for the last 15 years consecutively. They've also been paying one for the last 56 without a reduction, if that is worth something to you as an investor. But the first thing we need to uncover, because we did get a borderline safe dividend score, is what is their payout ratio. As always, free cash flow over earnings, which is susceptible to manipulation by management through accounting. We want below 60%. Ultimately gives us faith management are able to offer some nice increases, and we have a few red flag indicators. First one, anything above 100%, like 2019, like 2023, like on a trailing 12 month, indicates management are paying out more in dividends than they're generating in free cash flow. Now, yes, it is expected to drop to 90% in the next 12 months, but bear in mind, if this continues to be very high, well above 60, in fact, around the 100%, then it is very likely we will either get a dividend cut or in fact very trivial increases that are below 1%. Remember, these are things you do need to understand, especially given this is a high dividend yield company. It may not stay that way for a very long time. Free cash flow, typically we want to see consistent growth over the long term. We're not getting that, and it is pretty much expected to remain the same as 2024. Again, considerations to be made. And whilst you could argue from 2016 to around 2021, top line growth for the industry in is fairly attractive, but we are noticing now over the last few years, very minimal growth. 2023, minus 9%, on a trailing 12 month, only 1%. Again, in real terms, when incorporating inflation, that is a decrease. And we can see total sales pretty much on a downward trend from 2022. Question is, will their fortunes change? Can management really drive top line growth, which ultimately means higher volumes? Because if they start to really jack up the prices, then that could drive customers away. Shares outstanding, now they have been doing share buybacks, which ultimately returns excess cash to investor pockets. Not at a massive rate, bit slow year on year, little bit of a bonus, but something worth highlighting. Maybe they stop paying a very large dividend and they do some more share buybacks. ROIC, actually quite attractive. Typically minimum 10% is what we want to see. Gives us faith management are able to effectively allocate their capital. Yes, it is declining, something to watch, but 14% last year, 13 on a trailing 12 month is still, for the time being, fairly attractive. Now, margins, we want to see at least 12%. It's been straddling around that year on year. Now, we'll compare it to the sector. Not great. It's been decreasing from 2022. Ultimately will affect their bottom line net income. Free cash flow margin doesn't look too bad, straddling around the 5% minimum. Now, one of our favorite metrics, net debt to EBITDA, and also correlates to the dividend safety that we saw, as well as balance sheet strength. What are the number of years it would take UPS to pay off all of their debt? Now, we note here, maximum of 3. Whilst it's been below that every year, consideration to be made, 2022 lows at 0.88. It's only been increasing and expected to climb over the next 12 months. Now, it's nowhere near the maximum threshold that we want to see, but again, something we definitely believe is worth flagging and you should also consider. Now, growth ultimately very important at a D-. Last year, it was only 1%, expected to decrease 1%, in fact, in 2025. On both accounts, below the sector and their 5-year average, which is still low single digit, but nonetheless, at least it's positive. EPS expected to grow 5% in the next 3 to 5 years, below the sector at double-digit rate, and also below their historical 9%. Profitability, whilst we get an A+, their gross margin pretty poor, 21%, given the sector sits higher at 31%, but actually not too dissimilar from their 5-year average. Bottom line net income, 6%, in line with the sector, but we're seeing deficiencies. Margins are actually compressing. Historically, it's at 8%. Cash from operations also decreasing at $7.5 billion. Yes, sector is much lower, but just look at their own 5-year. That is around 50% higher at $12 billion. Now, what are the institutions doing with their 60% ownership? They've sold $8 billion. We're talking just in the last year. They've actually bought nearly twice as much at $14 billion. They've also bought twice as much in the most recent quarter, $3 billion buys, $1.5 billion selling. So it does look like they seem to be taking advantage of this massive share price drop. And it's not just them. When we look at insiders, 0.1% ownership, yes, $1 million worth of selling in the last year. As always, insider selling doesn't really give us too much information. They sell for many reasons, personal and financial. Insider buying, though, that is what we would say a very bullish signal. Insiders buy because they believe the share price will go up. 1.5 million worth of buying in the latest quarter. Now if we take a look to see who these insider buying, interesting to note, we actually have Marjorie here, the Congress member, buying at around the $87 mark, but more importantly, the bulk of this buy has come from the CEO, who added on the 1st of August, and that cost him around $1 million. We also have the director just a day before, in fact buying 5,000 shares, $433,000, something just to take a note of. Now, as we said earlier, we want to see, is this industry as a whole not performing great, comparing them to others like FedEx, like Deutsche Post, and some very well-known names. Now, in the last year, including reinvesting those dividends, UPS the worst performing, down 32%. We have FedEx down at around 21%. In fact, these are the only two with such a significant drop in this period. When we extend the last 5 years, a very telling picture. The only company that is down negative 37%. FedEx, yes, not great, but you're still up around 4.5%. Over the last 10 years, again, picture very clear. UPS up 21%, the worst performing. FedEx, while still not great on this period, they're up much higher at 87. We can do the same thing against the S&P. Ultimately, investing in individual companies you want to outperform. Otherwise, what's the point? Just invest in something like Vo that tracks the S&P 500, down 31%. In the last 12 months, S&P up 17. Over the last 5 years, down 37, S&P up more than 100%. And over the last 10 years, 20% versus 245. Considerations need to be made, but remember, past performance isn't an indicator of the future. Let us know what you believe the next 5 or 10 years, in your opinion, has in store. Then finally, before we jump into our own valuation, quick 2 things to look at. First one, income statement. Revenue has clearly been increasing over the period, 58 billion, now sitting at 91, although we did highlight the decrease. The question we want to ask here is though, does the bottom line net income reflect this transition? Are we seeing growth over the period? And actually the answer is no, very, very inconsistent. And in fact, from 2021, a decline, another what we would call red flag. 5 billion though, if you want to look at it in isolation, now sitting slightly higher at 6. But as we said, a decrease from 13 billion a few years ago, now to just under 6. And the other one is a quick health check, total cash versus total debt, which actually, again, inconsistent, but that isn't typically an issue. Going from 5 billion 10 years ago to now sitting at 6. We want to understand how does that compare to the total debt numerically and directionally, because one number here in pure isolation doesn't really give anything away. And actually we notice while cash not too dissimilar, debt has been rising, 14 billion, now sitting at 29. Another consideration, remember dividend safety, 50 borderline, is something we need to consider. Now, before we jump into our valuation, we want to let you know we have released our latest free weekly article. We draw one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. We'll also be able to gain access to severely undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year. And you can also grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now jumping into our intrinsic value, we get to $105 derived from the average of the 4 models. Now we can jump straight in explaining each one. First one being Graham's valuation. We have the earnings per share, we have the long-term growth rate, AAA corporate bond yield, to give us an intrinsic price, $75 below market value, so our first overvaluation signal. But remember, we don't look at one model in pure isolation. Next one, multiples valuation, companies that we just looked at, similar size in the same industry, average P multiplied by the EPS to give us $122 in undervaluation signal. And then moving on to the DDM, now we do see average growth at around 11 to 12%, but the last few have been very trivial, so we have gone for 1.5%. Remember, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, where we get another undervaluation signal, 102 versus 84, before ending on the DCF model. Now, growth rate moving forwards, we have 1%. Baked into the future free cash flow, if you're interested, is negative 3% year on year. So using the growth rate and the discount rate, we get the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, $120. So 3 undervaluation signals and 1 overvaluation. On average, $105, which actually isn't too dissimilar from where Wall Street see this into 2026, where they've noted 25% upside. Now, as always, on this channel, we like to kick off with a 10% margin of safety, where we execute by if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at $94, but this is highlighting right now at this price, if you're adding, you're getting a 20% MOS. Maybe that's enough for some investors, maybe not. If you want to make a note, at 25%, a buy at 79, at 30, a buy at 73, at 35, 68, and at 40%, $63. So let us know right now, UPS yield near 8%, potential dividend cut, or at the bare minimum, continuation of very low dividend increases. Wall Street, $105 into next year, 25%. Do you see this now as a buy, hold, or avoid? And don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us on Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.